Hello, and thank you all so much for joining us today. Today, we are blessed, honored, and excited to have Bruce Fain back once again with Turtle Creek Financial Group for part two of our six-part series. Bruce, first and foremost, thank you for making time for us today. How are you doing?
I'm doing awesome. How are you?
I'm doing well, thank you. I'm doing well. I want to thank you also for that last seminar. That was very educational, very applicable. I can't wait to see what you have in store for us today. So please give us, as you're getting ready to pull this up here, give us a little bit of a preview as to what we should be expecting for our discussion today.
Well, we're going to talk a little bit about the buy, sell, and how that affects business owners, both in the implementation of it and also the execution of it.
Nice. I think this is going to be another one of those fun ones where it really relates to that small business owner. Again, because we're at the McGraw Council, we're really trying to help that small business with fewer than 20 employees. And a lot of what you're speaking about today relates directly to that business demographic.
Absolutely.
So as you're pulling up that presentation, a brief highlight, going over to the last seminar, you talked a lot about retaining key employees. And that's, again, something that as small business owners are very familiar with that realm. You have some really good quotes and statements from Andrew Carnegie in there. HR is something that's a very difficult component to manage consistently. But when you can truly master it, then you build the team, you build it up, and retaining that or multiple key employees is huge. It is an incredibly difficult component to, first of all, find the right talent, then to retain it. It's not an easy task. And then obviously that ties into the whole, everything that we'll be talking about today's seminar and the following four seminars. Really managing the ownership level from a business perspective will be absolutely essential. It's something that's too often neglected. And when you neglect it, you miss the window of opportunity, because when disaster strikes, it's too late.
Can you see my screen there, John?
I can. I see the StreamYard screen. Can you pull up your presentation for me on your computer?
Well, that's what I did, and I may have to go. I don't know what hang on just a second, John. Give me a second here. For some reason, my StreamYard isn't loving me. I hate it when that happens.
Technology. Can't live with it. Can't live without it.
That's right.
It's one of those interesting things.
Share screen. Should I click just share screen?
Yes.
Okay. Did that. Now it's giving me, it says StreamYard allow, and it's asking me to
go ahead and click that blue button that says okay or next.
It's not giving me that button, sir. It's not allowing me to allow. I can do the presentation without it, but I'd rather have it if I could.
Well, what you can do too is send it to me in an email real fast. But if you click share screen at the bottom, and then it says screen sharing tips, and you click share screen, it should give you a few options.
Yep, I've got it.
Pick which one you want.
Okay. Share screen. I have everything up, but it's not letting me do it. What do we do, sir?
Why don't you go ahead and email me the presentation, then I can share it to my screen.
Okay.
We can get that pulled up.
Okay. Hang on. Just a second here, and I'll have it to you. I apologize for this. I don't know.
Technical difficulties happen. Give us just a minute or two here as we get this set up.
Okay.
It's been rocking and rolling momentarily.
Yes.
But no, you were giving me a little bit of a preview as to what we would be talking about today before we got on the call. And it's all extremely applicable. I think you said it in a really, really funny way. You were talking, it was like, very few people enjoy talking about finance, but we're not talking about finance. We're talking about each individual business and ensuring that they're positioned to succeed and thrive, not only in the short run, but particularly in the long run. And in the long run, I think something you really talk a lot about is those transition points, those key transition areas where you have a business owner exit the business, or you acquire a new business, or you bring on a key employee, or heaven forbid you lose a key employee. Dealing with those transitions, it's not easy, and you need to have a well articulated plan. You need to have a strategy, and then when it comes time to execute, you need to execute on that plan effectively and efficiently. I mean, time is money. I think every small business owner understands that you literally don't have time to get it whipped out.
You really don't. I've just about got this for you. Hang on just a second here. I apologize to you and to your listeners for this. I had this all up and engaged, and
that is a-okay. I think it's also one of those funny lessons to apply for like the overall digitalization stuff. Excuse me. I think we saw a lot of that in 2020 when COVID first hit. Everyone jumped into like 100% virtual and everything. I think
you got that in the email.
Absolutely. Let me quickly check my email inbox here. But yeah, no, when COVID hit, everything kind of got turned upside down, and changing it to a 100% virtual model and then going back to a hybrid model, it's not an easy task, but it's one I think that we as business owners have to say, look, this is where we're heading. This is where we're going. We have to embrace it, because denying the reality of it doesn't make it any better. Do you know what I mean?
I do.
Bear with me here. Waiting for this email to pop up for us. I got your email.
You do?
I do indeed. Let me quickly download this, and then I can display it for you.
Okay, good. Great.
And you can just tell me when to go ahead and click on through.
Okay, not a problem.
Share screen. Bear with me. And then we can get going here. Can you see?
I can. You got it.
Perfect. Just tell me whenever you'd like me to proceed.
Okay, let's see here. I'm trying to get this off here. Can you, let me see if I can move this down a little bit. Okay. Is that, we're good?
You can see the screen. Are you okay? Perfect.
I can see the screen.
Excellent.
So you're the slideshow. Go ahead to business continuity planning. And what we're going to look today at is the buy-sell funding arrangements, because buy-sell funding arrangements are so important. And it's not just how you fund it, but it's how you set it up administratively that's going to make or break a buy-sell agreement a positive thing for you and your business and those that it's supposed to benefit. And it is, without question, money at work. So you go ahead and click. And as always, we're going to look at economic reality and your personal economy, because at the end of the business continuity planning, it is all about your business, your personal economy, and your personal planning. And we're going to look at today, with regard to buy-sell, the entity purchase or stock redemption and cross-purchase, and what the differences are there and how they affect both the heirs and the surviving owners. Go ahead. And we're going to look at here, your enterprise, key employees. Go ahead, click through. And now we're going to stop here. We're going to look at the buy-sell part of this. And a male, and I realize there are male and female business owners, but for today's example, we're going to use males. Males in business owner partners from the age 45 to 65, there's about a 13% chance, or 13 out of 100 business owners that may lose a partner in a partnership. And if they are 3 owners or more, it's 18%, or 18 out of 100. Now, that doesn't mean that just because there are only 13 that the other 87 ought to say, well, we don't need that, because you don't know which 87 don't need it. And
Yeah, you don't know if you're in the 87 or the 13.
that's right, John, because I mean, if you had 8 houses on a cul-de-sac and the weatherman came on and said, well, we're going to have one tornado this year and it's going to knock out one of the houses on this cul-de-sac, you go to your wife and say, well, let's cancel our homeowner's insurance because it's only one, it's not going to be us. I don't think you do it that way, right?
Exactly.
Well, then there's also capital gains tax for the survivor of the business. Go ahead and click that one more time. And there is a right way, plan A or plan B, to do a buy sell. And in plan A, 90% of the sale of the business is considered capital gains, which basically would leave you with a 90% taxation at sale of the business at the death of a partner, zero living benefit to buy out or to have operating capital for the business. In plan B, you would mitigate that down to 40% of capped gains, giving you, go ahead, click one more time.
Can you give us a quick example of that, Bruce? Because if I'm understanding you correctly, that just sounds absolutely staggering.
Well, it is. And here's how that works. Let's say that you had a business, and today we're going to use $1 million. And I know that sounds like a lot, and there's a lot of business owners out there that have businesses less value than that, but these are easy numbers. So let's say that you had a startup business and each of the partners had $50,000 that they put into the business. 10 years later, one partner passes away, but the business value at his passing was $1 million. Well, the cost basis for the business is $50,000 for that owner, okay, that passes away. But the business sale at that point in time is going to be $1 million, okay? So the cost basis is $50,000, so you get that reduction. So you owe taxes on $950,000 at sale of the business to pay for the spouse's death benefit. Does that make sense?
I'm following you. Yep.
Okay. So what you want to do is you want to mitigate that, and through the process, mitigate that tax in plan A to the tax in plan B and mitigate that down 50%, leaving you not only enough capital to pay off the living survivor's the surviving spouse, but also for the living survivor to have operating capital in the business, because you didn't have to gut the business of operating capital to pay off the surviving spouse. Does that make sense?
I follow you. Yes, sir, it does.
All right, we'll click this again. So go ahead and click another. And we're going to look at the buy sell and how that looks, because income replacement is going to come into play here. Go ahead and click again for me, please. And a male at age 50, if he dies, the income replacement necessary is 14 times his salary. And so let's look at 14 times, if you're making $100,000 a year, 14 times his salary is about 1.5 million. Okay. So that's a lot of money. So you want to be able to compensate for income replacement for the surviving spouse. Go ahead and click again. Yeah, go ahead and click through that right there. Stop. And the retirement strategy roadmap says that 84% of Americans are very concerned about outliving their assets, and that only 11% of retirees believe that restaurants and leisure time are going to be part of their retirement activities. And then you look at, to get some realization there, you look at $1 million of retirement capital and the income that it could provide. Well, in a traditional retirement income situation, that would provide $40,000 a year at the recommended 4% per year withdrawal for that retirement. Or you could do what they call a coordinated strategy, which mitigates the risk or reduces the risk in taxation in retirement and can provide up from $90,000 to $120,000, and also provide funding for a long-term care benefit. Go ahead and click. You also don't want to find yourself in a lack of liquidity for estate equalization. due to lack of funds, which could create, a lot of distension in the family, and also legacy planning. If you'll go ahead and click there, if you're short of capital because we didn't plan for the buy sell properly, then there's no legacy benefit for the church or for the lodge or for the city plans that take care of kids and things like that people may want a legacy to live on. Go ahead and click. So what we want to do is we want to convert these issues into opportunities. And the way to do that is to properly fund and use our money at work in a way that's going to be beneficial, not only to the business over time, but for any unforeseen, unfortunate situations. Go ahead and click.
And for those listening, last seminar, we talked about money at work, money at risk, and money at rest, and knowing the distinction between each of those three. So as Bruce mentioned, this is money at work here.
Absolutely. Because at the end of the day, what we're doing is we're providing money for you to take care of these, because the problem at death for the partners and shareholders is how to provide continuity in the business operations for benefit of all parties, the shareholders and the employees. It's so important that you understand as business owners, it's just not you, mom, and the kids. You also have employees that have mom and the kids that you're having to take care of also. And how are you going to manage that for something or for unforeseen to happen? And how do you ensure the deceased partner's heirs receive a fair value for the deceased business interests? You want to make sure that those that are left behind for the partner that is deceased to get a fair market value. And how do you allow the surviving partner to acquire full ownership of the business interest without awkward entanglements? And we're going to get into that because there can be some. And how to facilitate beneficial ultimate exit for the surviving partner. Go ahead and click. So we're going to look at now a not proper funding situation for a buy-sell agreement. And we're going to say that the business arrangement here is you've got $1 million valuation for the business. You've got the enterprise. X and Y are the partners, and we're going to assume that X dies. And when X dies, the partner is now in business with X's wife. Go ahead and click. And X is rightfully going to expect that she's going to get income from the business continuing through the life of the business. Would you agree?
I see where you're going with this. I see where you're going. Yeah.
Okay, go ahead. Hey, is there any way to enlarge this picture that you've got here for me no?
Let me see. It's the biggest I can really get right now.
That's okay.
Okay.
That's okay. Okay. So Y now needs to work for both partners. Okay. And he can't afford to replace X because right now he's tied up with X's wife and he's having to pay her. Now, she may not be able to produce because she's not qualified to do what X did as his wife, but she also has great expectations on what the dollars should be that she should get because it's her husband's business. Go ahead and click. So Y is not just exposed to paying X's wife's salary. He's also exposed to X's circumstances, meaning that X's situation not only is salary, but she's exposed to X's adult children. Go ahead and click. Her accountant, her lawyer, and her new husband possibly. Go ahead and click. Go ahead. Go ahead and click. So the cautionary tale here is proper buy-sell arrangement has two components. A compulsory buy-sell arrangement, must buy, must sell. An effective, fully mechanized or to delivery the agreed amount when required by the effect of the buyout. if proper effective funding is not implemented, it may be better not to have a compulsory agreement or binding arrangement at all, because the surviving partner may find himself entangled in an even deeper in the situation and unable to perform on any obligation. Go ahead.
So, real quick, then, just to clarify, is it a fair statement to say this is very much situational depending upon each specific business and situation?
Absolutely, it is. And I would say that each business needs to look at and evaluate how that looks for them independently, not as a monolith that we're talking about here today. Because what we're doing today is exemplary of things that are out there and available to you. And if not taken advantage of, the consequences that could come to pass. And also, if you implement it, how it should be implemented and what the benefits and drawbacks of those things are. Does that make sense?
100%.
Let's go ahead. Okay, so now we're going to look at an entity purchase, okay? An entity purchase or stock buyback is what this is, okay? So what we're going to look at is we're going to insure both partners. The owner is going to be the business, the center there, the enterprise, and the payer is going to be the business, and the beneficiary is going to be the business. Go ahead and click. So we're going to say in the event of the death, so X dies, click, and when X dies, the business benefits $500,000, okay, and the business proceeds go to pay X, okay, the purchase price of the business. At that point, all shares are redeemed back to the enterprise and they go away, because now 100% ownership goes back to Y, okay? And X will also receive a step up in basis for the value of the business, okay, of that $500,000. So that will eliminate any tax for capital gains for her, okay? But Y will also get 100% of the business. Go ahead and click. So he has all of that, okay? Next slide. Okay, go ahead. And now what we're going to look at is we're going to look at a cross purchase. Cross purchase is a little different, even though it has some similarities. Cross purchase is we insure both partners, okay? But instead of the enterprise or business owning the policies, the partners each own their policy individual, and that's important. And what they do is they make, at that point, X is Y's beneficiary, and conversely, Y, you get it. So what you're going to do is you're going to use the business or enterprise is still going to pay for the policy, but the way they're going to pay for it is they're going to use the 162 bonus plan through the Internal Revenue Code to pay for that, meaning they're going to increase for the amount of premium and federal income tax on the 1099 to each owner of the policy. So the beneficiary of the premium of the policy is still going to be paid by enterprise, but just through the individual owners. Now, go ahead and click. Now we're going to, again, X dies. And when X dies, instead of the enterprise getting the money will go directly as an inheritance to Y. And what Y will do is Y will take those proceeds and pay X spouse the money, okay? X will also get a step up in basis, and what that will do is that eliminates any taxation for X's wife, so she gets that $500,000 tax-free. But Y also, when he pays her for the business, he gets a step up in basis, another X going back the other way, yes. And what that does is it gives why a step up of $500,000 in basis for the business, which when we look at this going forward in the next couple of slides, what we're going to see is how the benefit of entity purchase is different from the benefit to the surviving owner and beneficiaries of cross purchase. Go ahead. So the impact: deceased heirs get the money in a timely manner. The surviving partner gets control of 100% of the business. Deceased heirs get a step up in basis, so they eliminate capital gains tax. Survivor, or the surviving partner, gets a step up in basis so that he's getting reduction in capital gains exposure, and their surviving partner also exits with a preferred personal capital for his retirement maximization. Go ahead and click. Go ahead and click. So yes, all of those things are true, except in the entity purchase, the surviving partner gets no step up in basis. Why doesn't he? He doesn't because he gets no funding. The enterprise gets the funding directly, so there is no step up in basis for the surviving partner. So he gets no tax reduction or basis for that. And the surviving, so he's paying maximum dollar for the sale of the business, meaning he's paying taxes on $1 million. But if you look at the cross purchase, because he gets a surviving benefit there on the surviving partnership, he will get a step up because he personally benefited, okay, as a part of the policy when he received the $500,000 that he then used to pay for the value of the business to the spouse. Understand, he got that because he paid that for the business. So he got a step up in basis. And so having gotten the step up in basis, he has $500,000 more dollars to operate the business and put towards his retirement, as well as, if you look at it, he also gets the value of his policy goes to bottom line asset for the business.
So maybe a little unrelated question here for you, Bruce. How long would it take to set something like that up?
Well, you could leverage this. You could set it up in a minimal amount of time. Funding for it would be a different question, and that funding would be anywhere from 5 to 15 years for full funding. But what you're doing when you do this, and here's the part that probably most people want to know, is once you set it up, those dollars are in place to be executed right now. But the funding of it would take anywhere from 5 to 15 years, depending on how they wanted to customize those things for their particular situation. Does that make sense?
100%. Thank you.
Outstanding. Next slide, please. Okay, so what we're going to look at here is capital gains tax impact on the surviving partner, okay? So the business is valued at $1 million. Ownership is 50-50, and the startup capital was, and that is the cost basis. For anybody that doesn't know what cost basis is what you originally invested in the enterprise, okay? So life insurance proceeds were $500,000 for each. So are we on board there so far, John?
So far, so good.
Okay, because I don't want to jump out in front of anybody. So that's added to the survivor's cost basis, okay? But on the entity purchase, it is not added to the surviving partner's cost basis. So here's how that looks. So on the entity purchase, you sold the business worth $1 million, and the proceeds from that were $950,000 less the cost basis of $50,000, which was the startup capital. That's what is taxable to the surviving owner in an entity purchase or stock buyback. If you do cross purchase, then the life insurance proceeds, because it benefits the surviving owner personally, and he uses those funds to buy out the other partner, he gets a $500,000 step up in basis, which what that means is he gets to deduct off his taxation the $50,000 original basis and the $500,000 he used to pay for the partnership's widow's buyback. Okay, which means that, go ahead, click me, that life insurance, the personal proceeds received by him, would give him the opportunity for a step up in basis, which means that instead of paying $950,000, paying tax on $950,000, go ahead and click me one more time. And another, he's going to pay, click back, go back. He's going to pay taxes on $450,000. The question that you have to ask yourself as a business owner, would you prefer to pay tax at some unknown rate on $950,000 or on $450,000? And I think we all know the answer to that.
So just picking a number here again for easy math. Let me pull up my calculator for fun here, because I think this will really help highlight it. Pick a number, 30% times 950,000, about 285.
Right. So
if you apply that same one to 450, you're at 157. So the difference there is about $127,000 you saved through proper planning.
And where's that money going to be? That's going to be operating capital in your business that you do or do not have based on how you did or did not set this up.
And that's where planning comes into play.
That's exactly right. And that's why it's so important to look at this point in time, what your situation is and what your exposure is. And let's not leave out the independent owner that doesn't have a partner. If he doesn't have a partner, he needs us even more.
Well, that's a good clarification too. How would this relate to a solopreneur?
Well, let's say that you have a solopreneur out there and he's got a key employee, because we've talked about that, and he's got 10 employees. Well, if he's got this and he dedicates it so that the key employee who's had interest in 5 or 6 years in owning the business, he could make a beneficiary of he and his wife. Wife gets the buyout money, and you go to the bank and say, I need $300,000 and I have $150,000 in non-taxable death benefit and a business that makes this much money. Can I get a loan? Well, the answer is probably yes, because you've got $150,000 in skin in the game and you only want $280,000 to $300,000. Does that make sense?
Yep, you have something you can really leverage as collateral.
If you don't have that, then mama's getting nothing, because the business dies at that point, okay? And the key employee is going to work someplace else because he can't go to the bank and say, I need $300,000 and I've got no collateral because I don't know the business. Does that make sense?
100%, 100%.
So surviving partner receives the step in basis and cost basis for the interest, reducing the cap gains tax exposure. This is important. Why? Because U.S. cap gains taxes rates have fluctuated between 10 and 70% over the last century, and it has provided significant tax savings and wealth conservation potential over time. Survivors with tax-preferred personal capital for retirement maximization estate planning is absolutely, because a pre-funded permanent index life insurance contract is a significant asset for personal retirement and estate planning. I can't tell you, in one of these policies, what if you needed $20,000 and you didn't want to go to the bank because your business is suffering a little bit? You could go to the policy, get the $20,000, work through the difficulty, and pay the policy back. No tax consequence. I can't overstate that. Now, some of your clients are probably going to go, well, how does he do that? Well, I'll tell you, the answer to that is we sit down in a personal conversation and I show you how that works. because doing it in general information like this, we're going to go over time because there's just too many questions that you would have. Does that make sense?
100%, because a lot of those questions become very situational based upon the specific set of circumstances that exist. And so you can't have a one size fits all solution because it's not one size fits all. You have general principles that apply, but when you're starting to get to the where the rubber meets the road moment, that will be very individualistic.
Absolutely. Let's continue. Okay, here's where the rubber meets the road right here, because putting a contract in place like we've talked about, whether it be entity purchase or a cross purchase or whatever, isn't the only way you can do this. You can do it by saving personal funds dollar for dollar. You can go get a bank loan, which is going to require you to pay interest. You can use a sinking fund, which will pay interest and cost you a little less on the dollar. You can do installment payments, or you can buy insurance. Go ahead and click that first one. Basically, what that's going to, if you're going to do dollar for dollar, that's going to reduce your ability to have operating capital for both investment and emergency situations. Go ahead and click. And I just covered that. Also, you look at bank loans. First thing you got to ask yourself about a bank loan, if you lose a partner, okay, you've lost production there. Okay, so you've reduced your value. Okay, and I don't know about you, but I've been to a few banks and I understand that they want to make sure that you can pay for it. So you got to first figure out, is the bank going to loan you the money? And then when the bank does loan you the money, to pay back $1 million in 10 years is going to cost you about $10,600 a month. Now, on top of that, the bank, go ahead and click, is going to require you to pay secure that collateral of about $1.3 to $2 million. They're also, as a part of it, going to require you to maintain a certain amount of money, and I'm talking about liquid operating capital, unencumbered, unattached, for them to maintain that loan. And you, over 10 years, as the business owner paying this loan back, are going to pay about $275,000 in interest alone. So you need to think about that. Then the sinking fund. Well, the sinking fund is a good idea, provided that you're going to have enough time to get that done and that you're making enough capital each month operating to pay about $6,800 to set aside in that sinking fund. Because the sinking fund, although it is a cash account, right, John?
Mm-hmm.
But that's set up as a long-term debt payment account, so you can't use that money once you put it in there as operating capital. It's like it's in a vault.
I mean, you're highlighting on all these points so well. I just want to quickly throw in like a personal experience on this one. There's a time and a place for all of these, but you have to go through and think about which one is best for a specific point in time with the specific set of circumstances. And you can guess your way through, but you're kind of on a coin flip. And that's where it's really beneficial to have a subject matter expert come in and say, hey, based upon the set of data that you've got, based upon your situation, you're probably going to want to lean this way.
Absolutely right. Absolutely right. And that's the reason, because we're not telling you, and John, that's a great point, because I want it said that I'm not telling you that setting up an entity purchase or a cross purchase is the only way. You can do dollar for dollar. You can go to the bank. You can do all of these things. What's going to be best for you in your situation, and to get that evaluation done is one of the most important things you can do. Go ahead and click us. So what we're looking at here is you're going to be paying executive salaries for 2 executives. Was only one of you working. You're going to have, you remember, it's not properly funded. So now you're paying the family basically, and they are in there with their CPAs and lawyers, and they're telling you how they want things done. That can make an installment plan over time a very difficult situation. And paying $10,000 a month on something like that, you better be producing at a most impressive rate, I would think.
You would think.
I would. And then there is insurance. And the beauty of insurance, we just talked about it a little bit, John. We got a little bit ahead of ourselves, but that's how you are. You really are reading the situation very quickly. And that is, once you begin this, you ask how you set it up. How would it work? Well, it works this way. Once you get it set up and you get it executed and it's in place, you have 100% capital availability right then, right there. So if something happened, you could pay for it. It's often called the interest only. And the benefit, the death benefit, pays all loans. It's just, so what you want to look at is, furthermore, with a properly funded buy-sell arrangement, if neither party dies, okay, which is most likely, each party ends up owning significant personal preferred cash values in their life insurance contracts to facilitate a living buyout. Let's say you got to a point and you said, you know what, I'm going to go ahead and buy out. I can use the funds from my policy to pay you off, okay? Or if I don't want to do that, I can use it as a personal retirement asset. And these assets grow tax-free, and they are income tax-free and capital gains tax-free, and they are exempt from any kind of claims or creditors. It is an awesome opportunity for you, but it's not the only opportunity for you. I can't overstate that, because I'm not here to tell you one way or the only way. There are several ways, but you need to look at how you leverage your capital. Does that make sense?
100%.
Go ahead. Okay, so let's say that you're going to do a traditional retirement and you get $500,000 for your benefit. That's going to pay you $20,000 a year for 30 years, plus your Social Security. So let's say with Social Security, you got $45,000 a year for the rest of your life. Or you could use, with the second SAC system, which is part of the Life Pro that we looked at going through here. And what you would do is just kind of diversify all the assets, use them in a way that you could spin them down in a structured pay down scenario at a larger than 4% over a shorter period of time. Go ahead and click. And the reason would be because you have a second sack of money out there, and this second sack of money would, go ahead and click, would provide you, go ahead and click. It's going to provide you with a tax-free benefit with cash flow. It's going to provide us tax-free survivor benefit. It's going to also give you critical care, and I can't read the rest of it, and I know it, I just can't see it. But bottom line is, with regard to the second sack of money, it's going to provide you with confidentiality. It's going to provide you with both critical care, long-term care, and terminal illness benefits, and it will allow you, in the transition from your working life to your retirement life, to live on a closer to your working life salary than capitalization would. Go ahead. The income tax free. Now, what we're looking at here is the Life Pro that we look at, and it's going to provide tax-free retirement cash flow. It's going to grow tax deferred. It's going to have an index market driven growth. It's guaranteed account value bonus enhancements. It also has a contractual asset management. In other words, there is no market risk. Income tax-free survivor benefit. It has an optional death benefit, disability benefit. And what that means is, let's say that you, or 45, you put this in place, and at 50, you became disabled. You would have, this policy would pay for itself until you were 65. But during the time between 50 and 65, if you needed money, it would pay you that money in addition to paying for itself. It also is a confidential vehicle. It has credit exemptions, and it provides critical and chronic care benefits. Go ahead. click through that real quickly. Okay. So what we're doing is buy, sell. And what we're doing here is we are using one set of dollars. Go ahead, click. And with this one set of dollars, we're putting money to work, and we are addressing 6 of the 8 major issues in the 8 vertices with the 4 core issues of the owner's problems. Go ahead. And basically what you want to do now, if this is something that you want to look at, applying for a life contract and to confirm your eligibility. You just need to apply. Most of the time you can do that online. Confirm the business value, because obviously you want to do something that's going to provide business value if those benefits are needed, and you can get a formal or informal valuation, and a willing buy-sell agreement. And you want proper, appropriate documentation for compulsory documents for the buy-sell, and you also want to execute the documents for all concerned. Okay, and understand that the writing's so small here I can't say it, but I'm going to paraphrase that Turtle Creek is not a legal firm. We do not have or provide legal advice to anybody, but we do provide paralegals that have documents that you can look at to execute these things if you want to go ahead and click through, so that we can help you and your local attorney setting up and executing documents as need be. And we can set up so that you can look at how these assets and business interests and retirement accounts can maximize your retirement and income protection. And that's all I have, unless you've got questions, John.
No, I think you hit everything right perfectly there. Thank you so much for taking time out of your day to, again, share that with us. A lot of where the rubber meets the road moments, and a lot of the discussion that did not take place is very situational. So I think the call to action here for anyone listening, if you don't have a transition plan, if you don't have a plan for life after the business, you need to get a plan together. And it's okay if you don't know how to make that plan. There are subject matter experts out there who do, because leaving your business without a plan is planning to fail your business. And that's not what we're meant to do.
Well, that's absolutely right. And I'll tell you, one of the reasons that I use the charts that I use and the slideshows is there's so much information. I could stand here and talk, but and do this without the slideshows, but you have to understand, most people we've learned are visual. And if you've got this down, they can take better notes as you go along. And it's such important information we see out there that people need, that we feel like it's better if they're able to get all the points, because so easily, you and I have talked several times, we spent nearly 50 minutes doing this in a presentation that normally takes me 20 minutes to present. And you don't want to get sidetracked and leave something important out.
Exactly. Hit the nail on the head. Bruce, thank you so much for your time today. We'll obviously have a recorded version of this available. We'll have it in our newsletter, and it'll be available on different social media websites. Thank you so much for your time, for your expertise, and I'm very excited to see what transpires in part 3 in 2 weeks.
Outstanding. Thank you for your time. I was honored to be here.
You stay safe, stay blessed, and we'll talk soon.
Yes, sir. Thank you.
Bye-bye.